There are lots of factors that move currencies. These include interest rates, inflation, economic growth, energy prices, commodity prices, and a lot more besides. One of the other factors that currencies respond to is global uncertainty. And there are some currencies that are called safe haven currencies. Typically, they include the dollar, the Swiss franc, and the yen. And they're called safe haven currencies because when you have big geopolitical or economic shocks, global investors tend to go into those currencies for protection. Now, what we do is we untangle all this complexity using machine learning and computing power. This gives us a real insight into what's driving a particular FX rate. Not only does it tell us what the drivers are, but it also identifies dislocations. And one of the dislocations that currently stands out is the dollar versus the Swiss franc. Now, both the dollar and the Swiss franc are safe haven currencies. But the machine is telling us that right now, dollar Swiss is 1.5% too high. That means the dollar is 1.5% too expensive relative to the Swiss franc, given all the information out there. Now, whenever we've seen a gap like this over the last 14 years, and you've initiated a short dollar Swiss trade on the back of that gap, there has been a 76% win rate. Those trades over the last 14 years have made money 76% of the time. So the odds are definitely in your favor. The other thing to bear in mind is that the average holding period is about 2 weeks. Good luck out there.